good point.
Seven's the key number here. Think about it.
Right.
Seven
11s? Yeah.
7 dwarfs? 7, man, that's the number. 7 chipmunks twirling on a branch, eating lots of sunflowers on my uncle's ranch. You know that old children's tale from the sea?
Hi, everybody. This is John Baranauskas, and I'm with my co-host here, Chris Hastings. This is a new social outreach that we're doing called Storytime with Hastings. Chris is an old coworker and now is a member of my firm, Sweetgum Labs. This is the format of this show is going to be about trying to make the approach to financial planning as human as possible. Between us, we have almost 50 years of experience. Chris and I were just talking about this beforehand. So I think we have the product down. I think we have the experience. Chris, welcome aboard. Thank you for making the time today, and I appreciate you coming on.
My pleasure, John.
So I'd just like to pick your brain, maybe share some of your experience, just share some of your background, and then just share what your thoughts are on fixed incomes. I think a lot of people are probably scared to see what the next 15 years are going to look like in that arena.
Well, thanks, John. Doing this for about 27 years. When I started in the business, I was with a firm called Kidder Peabody. Where I remember my first day, we had about $1 billion under management. And he said, "How do you like tax-free municipal bonds?" And I said, "Well, I like bonds. They're easy for me to comprehend. They're easy to explain to the client." And he said, "Good, you're our new tax-free muni guy for the team." Well, that was kind of my thing. Was every day I'd sit down and say, "Where's the yield?" And I know that's the discussion in today's world is, where's the yield? And in most people's portfolios, a large percentage, and as you get older and towards retirement, the bulk of your retirement assets are going to be in fixed income. So, and here we are in basically a zero interest rate environment trying to find yields. And we can't excel our risk tolerance to basically get a better yield. It defeats the purpose. That's our safe money. That's the portion of our assets that's meant to be basically a capital preservation mode. So, bonds have changed. Now most fixed income products are packaged. They're put into a platform where you're paying basically a fee on an annual basis to own those bonds. The fee is not as high as, say, if you were doing a full equity model, but it's still, 0.75 of 1% or 75 basis points. So it impacts when you're trying to find yield, and now you're telling a client, well, we're going to be paying, almost 1% in fees every year. It becomes a huge percentage of the yield we're trying to capture. There still has to be monitoring, measuring, and here we are now. What are we going to do going forward, John, as far as interest rates? What should we be looking at, not only in stocks, but in my world as far as fixed income?
Yeah, no, I mean that's been the $1 million question. I think for probably 4 or 5 years now, maybe going back to 08 or so. And there doesn't seem to be an end in sight of quantitative easing and the easy policy that's been in place since then. And they sort of try to tiptoe out of it, and then the market had a reaction that was negative, and then COVID happened, and here we are stuck into this world. We got to the point we just spent 5 minutes here kind of going into our craft, right, a little bit. And how do we humanize this for the individual out there that's just trying to scratch their head and say, what do I do then? Because I've had that conversation with people that are saying like bonds aren't really making us enough money to justify the manager fee, to justify your fee, and to give me a return that's worthwhile. But then does that mean asset allocation's dead? And I'd say probably not. But I guess just from your perspective, I think you have a gentler touch than I do from the human side. How do you position it to somebody when they have that conversation?
Well, I mean, you have to have a home for these assets. You just brought up a great point. You can't put all your money in stocks. And we do the asset allocation. We do look at the percentage breakdown, the primary layer, which is, cash, equities, bonds. I mean, fixed income, what percentage should I have? And as you get older, as I mentioned earlier, that percentage of fixed income increases as you get older. So we need a home. I think a lot of people are searching. You have money managers who are sitting on the least amount of cash they've ever sat on. On the other side of the table, you have people like homeowners, investors sitting on the biggest pool of cash they've ever sat on in their banks, making no money. Yeah. So there's kind of a disconnect there. the professional money manager are using all the money they have cash wise. The home owners, the personal investors are sitting on more cash than they ever have. So
I think one thing I struggle with, and if you have inflation, that means that rates are probably going to rise, right? So then the owner of this fixed income that has been seeing low returns the last couple of years theoretically should experience a paper loss at that point, right? Because rates are raising, therefore the bond should decrease. And I think part of our own, this is where I kind of conflict on my own ideology of how I approach things, is I don't want to try to time fixed income. But at the same time, if they stay where they are and rates increase at some point, which they probably will, they're probably going to end up losing money. So how do you balance that? I think that's a question I can't really answer. I don't expect you to either. But if you have any thoughts, I'd be interested to hear on them.
Well, I mean, on an individual bond basis, it was easy to do a ladder. And obviously, I've been in interest rates in 27 years. Rates have been up, rates have been down. Nothing changes. It's kind of a circle. So when rates are down and they're moving north, we do a 1 to 3 year ladder. So typically with $1 million, I would break it into 4 pieces, maybe 4 years, and do 250 in each year. Pick something that's safe, whether it be bonds, I mean, munis or corporates or whatever it might be. I've done it with all of them. And then as each bond comes due, you have a bond coming due in 1 year, that gets added on to the back end, and now it becomes a 3 or 4 year bond. So it's a continuous circle rotation that you've created to take advantage of rising interest rates. When there's a fear of inflation, we're moving to gold, we're moving to real estate. We're looking for shorter term investments that pay some type of yield. One thing I found extremely interesting last night, and I've been a big tips guy forever. I mean, Treasury inflation protection securities, their bonds or Treasury bonds are backed by the full faith of the government. They're currently trading at negative yields. Why in the world would anybody buy a bond with a negative yield? And I've searched high and low, and have your own kind of insight, but there's nothing else out.
It's a weird moment in time, and I think from our perspective, you have to have the full asset class, all the asset allocation, all the asset classes that we recommend to protect you from any storms, whether it's from a government storm that creates treasury volatility or corporates or whatever. I think that's where my mind is. Do you sort of align with that? Or what you're thinking?
No, I agree. And you make a great point. A lot of that asset base was from churches, from condominium associations. There's bylaws, entities, nonprofits that I've managed. They have bylaws where they can only invest in pre-approved fixed income.
Yeah.
So they have no choice. So you bring up a great point. The money's being forced into the fixed income market, and it's being forced into the safest of safest investments, the treasuries and so forth. So automatically you have hundreds of millions of dollars going in, no matter what the rate is.
Yeah. I've been hearing a lot of advisors say that equities are the only game in town. But then, but then treasuries are the only game in town too, right? So there's really 2 games in town, I think, right? And I think but the one really isn't performing as well as the other, and the other one's about safety, and the other one's about performance. So it's hard to, again, hard for Joe, retail investor, to really determine, hey, I still need fixed income regardless of the rates. I think that's hard for them to sort of stomach.
It's all part of the balanced conversation. I mean, call it cylinders in your car, we're all running. I mean, bottom line is we're not going to be hitting home runs with all angles of the market, with our fixed income, with our alternative investments, with our stocks. And it's not meant to be that way. If you imagine everything going up forever, it's not going to happen. You'll see the rotation. We're starting to see it now.
The rotation is constant. You can see that, like going back to that map of the guide to the markets I was talking about earlier. You can see that every year that there's certain years that commodities have killed it, and there's been decades where it's been doing terrible, and stocks and REITs and everything else. So it's just part of the cycle. And like I said, I think as long as you have exposure to everything, you'll be able to reap it. Chris, we went way over our time today. I'm gonna try to clip this down a little bit on the editing floor a little bit. But thanks again, and we'll catch up in a couple of weeks. All right, Chris?
You got it, boss.
All right, man.